Okay, we're recording. So,
Hi, everyone. This is Group F on assignment number 2, which we've titled, interestingly enough, Case 2.1 Analysis Case. And we have Josh Baker, AJ Bergen, Tice Robinson, and David Torres. So, first part of the assignment, we just have our common size balance sheets, just a side-by-side comparison. Um, we'll kind of go over these a little bit more in detail for each one of the sections, but probably the biggest one to kind of call out is, Medtronic's is pretty sparse, just pretty basic. Abbott definitely expands, especially in terms of inventories and breaks down kind of those individual components under its inventories there.
yeah, and if you look at this, especially, it's really prevalent in property, plant and equipment. Abbott lays out a lot more than Medtronic does. They have land, buildings, equipment, construction in progress, while Medtronic just has it all kind of lumped into one. They both do have goodwill sections and they both have these total asset sections here. But as you can see, Abbott's is a lot more refined and a lot more descriptive than Medtronic's is overall. Um, Medtronic here, their current liabilities and Abbott's liabilities, they're pretty equal. They're both pretty descriptive. Um, from the looks of it, Abbott has a little more dollars cash flow going through long-term debt. Medtronic actually has more with about 23 billion compared to Abbott Labs 13 billion in 2023. Total liabilities, Medtronic had a section for total liabilities while Abbott Labs didn't. That was really interesting to me while we were going through this, but they do all lay out their current liabilities pretty well. Um, Shareholders' equity, like I said, they're both doing really good reporting on their shareholders' equity. They both have like total equity. So these totals down here, while they're named different, they do mean the same thing. Medtronic had more liabilities and equity compared to Abbott Labs with 89 billion, while Abbott had 73 billion. It's interesting that these both report on the same things, but they have different names, obviously. And Met or Abbott Labs does have a little more they are a little more descriptive in their investment names. So it's a little more complicated looking at Abbott's, but Medtronic's is definitely a lot easier to read. Okay.
Under the asset section, I have Medtronic. So breaking it down, you could see the types of assets. So cash and cash equivalents, investments, accounts receivable, inventories. So kind of their more liquid assets account for almost a quarter of their total current assets. And then PPE plays a small amount. And as you can see, goodwill and the other intangible assets are they're probably most significant by percentage, with those two combined, accounting for about 60% of their total assets. So, and with goodwill essentially being an intangible asset itself. So a good chunk of their total assets are tied up in some type of intangible assets.
All right, so moving on to Abbott's. Abbott's assets take up two slides purely because they had a lot listed. Um, so one thing going through this, I noticed a lot of their asset values were determined, interesting enough, by COVID. Um, COVID struck obviously the healthcare industry pretty hard. And so a lot of these were affected, like continued to be affected by COVID. Another thing that determined the asset values for Abbott was fluctuations in different exchange rates through the US dollars and other currencies since they are an international company. Um, so this part was what was most interesting to me. Um, they were really descriptive in their property and equipment at cost. So in 2023, Abbott acquired two major firms. One was Bigfoot, which helps develop diabetes management. They purchased that, and they also purchased um, an acquisition of CSI. So if you can see, their their total assets, it went down, especially their cash flow on the previous slide. Um, so interestingly enough, so buildings and equipment was another thing mentioned directly in the notes that I saw, and they lease approximately 44 million square feet, which is about 65% of what Abbott actually uses in their facilities. They operate about 90 manufacturing facilities, and that is accounted in cost here. It has actually increased over 2022. So 2023 saw an increase in both property and in cost. That's very prevalent in the construction in progress. You can see it went up by $1 billion. Equipment went up. Um, Buildings went up because they're leasing more and more land acquisitions. So biggest acquisitions by far though were those two companies, and you can see it in the slight drop in their cash and equivalents. It cost them probably about $2 or $3 billion total to acquire both of those companies.
Um, I know we had under the notes to financial statements, accounting method used on the Medtronic side that is listed on page 57 of their notes to accounting statements. They have about 50 some pages of notes there. And the FIFO method is used there, so cost determined on a first in, first out basis. Tice, anything on the Abbott side?
Uh, no, like I said, a lot of Abbott's assets were acquired last year and it took a dip in their cash flow, but their acquisitions, I think, have laid a pretty solid foundation for 2024 and beyond. So,
Um, Other information from Medtronic's asset accounts, from the notes on the financial statements, I think kind of worth noting because they have about 60% of their total assets from goodwill and other intangible assets. They have specific callouts on page 58 and 76 to 77, specifically on goodwill and intangible assets. And a lot of those are coming from acquisitions, which they kind of provide more detail, specifically what those acquisitions are that led to changes, increases in goodwill and intangible assets there. Um, and then they also specifically call out those acquisitions and dispositions on page 63 to 65 to give a kind of broader picture of like what are they acquiring, which would be probably important from an investor standpoint, and then have a direct impact on that goodwill and intangible assets.
awesome. Okay, so now,
And then, oh, could you go back 1 second too? And then
sure.
I just have uh, I would say significant changes to asset structure. When you look at side by side, those numbers haven't, the horizontal analysis, the numbers haven't changed significantly between either Medtronic or Abbott. Um, really probably a matter of a percentage point or two from a horizontal standpoint. So I would say not significant, meaning that they're pretty stable from year over year with each company. Um, I think the differences between the two companies are definitely their cash on hand varies considerably with asset retaining a lot more, um, and then Medtronic having more in investments, and then um, goodwill and intangible assets. Medtronic has about 15% more of those in comparison to Abbott. So those are probably some of the key differences between the two companies.
Hello, my name is David Torres. Today I will be going over the allowance for doubtful accounts for for Group F, and so that being Section C. And I will be also be going over Section D. But first, in Section D, the allowance of doubtful accounts is the amount the company is not expecting to have in return. So if when a company is giving money out or is investing a certain amount of money, some of that money does not return, and so there's an expectation of the money that they won't be able to recover, and that is your allowance of doubtful accounts. We can see the allowance out of doubtful accounts as a percentage of accounts receivable in 2024 for Medtronic specifically. In 2024, we can see is 2.75. 2023 is 2.85, a 0.10% decrease. So that means that they're gonna be collecting more and expecting less of not returning. And then as far as how growth rate goes, Medtronic sales increased by 3.64%. Total consumer debt increased by 2%. So they're giving out more. Maybe it's a reaction based on sales coming in as an increase. And then total amount I expect to collect lower by 1.7%. So again, they're collecting more and expecting less and not receiving the amounts they're giving out. For Abbott Laboratories, we can see that the company does not expect to collect 6.33 of their sales in 2023, which is a pretty big drop from the comparison to 2022, which was 7.44. Going into the growth rate, net sales decreased by 8.12%. So unfortunately, that's not a good thing for the company, and the consumers debt increased by 4.33. That's something they may want to look into, since if their sales are decreasing, they might not want to give money out or invest in other things right now. And then we go into a total amount that I expect to be collected, lowered by 11%. So again, there might have been a reaction from them to to be able to collect more and expect expecting the money not being collected is a lot lower. Then moving over to liabilities and Section D. Starting with Medtronic liabilities and also with Abbott, we're going to go over the significant liability of each one and the changes of year to year in both liability and equity. So starting with Medtronic, the most significant liability, we can see that is long-term debt. It's in 2024 is 26.6 and 2023 26.7, which is a 0.17% difference as far as year to year. And so we can see here how not much of a difference that has been. They have paid a little bit at 0.17%. However, they want to look into also, maybe they increasing that change a little more for the better, of course. Another thing that was looked over here is the current debt obligations. It went from 0.02 to 1.2%. So maybe the focus was paying some obligations they needed to take care of before paying some long-term debt. So that could be a possibility of why the long-term debt wasn't that much of a decrease. Then moving over to Abbott Laboratories, we can see that as far as comparing changes in the liability and equity structure from last year, from the year to from year last year. On the liability side, we can see that Abbott most significant liability is also long-term debt. From going from 2022 19.51 to 18.57, which is almost a 1% decrease. So that is a good thing for Abbott to be proud of, and moving over to shareholders' equity. Medtronic, the biggest, didn't really have much of structure changes from year to year. However, the biggest one that I could tell was the negative 1.33% in additional paid in capital. So maybe there were some payments that were done for that. And then on Abbott's laboratory equity, the biggest change from year to year that happened here is the earnings employed in the business increased from 47% to 51%. So maybe they either hired more people or their bonus. There was an increase in raises. There was raises for incomes, so on and so forth. So this makes up for section C and D. And thank you so much for watching. Bye-bye.
Um,
All right, so I had leases, commitments, and contingencies. First, with Medtronic, overall trends in the company's leasing data showed stability in key areas like operating, lease costs, and finance lease obligations, staying at around 273 million and 107 million respectively, indicating just good and effective lease management. Short-term lease costs have steadily decreased. And on the other hand, cash payment for lease liabilities have increased over the past few years, and this reflects higher outflows, but manageable obligations. The lease maturity profile reveals long-term commitments, particularly the 444 million beyond 2029. But the company appears well positioned to handle future lease obligations. These trends point to financial discipline and a controlled approach to managing lease-related expenses. Abbott, their lease obligations also show general stability in operating lease costs, but also in cash paid for lease liabilities. They each decreased slightly, but still remained at about 355 million and 275 million, respectively. This indicates effective lease management as well, and improved cash flow control. However, the right of use assets from new leases could signal reduced expansion, potentially raising concerns if growth is their priority. The weighted average lease term has shortened, offering more flexibility, but also reflecting uncertainty about future leasing needs, while the rising discount rate indicates increasing interest costs that may affect future agreements. Overall, Abbott's lease obligations, they seem manageable, but the drop in new leases and rising interest rates could present challenges in the future if growth and cost management aren't closely monitored. For commitment and contingencies, Medtronic's commitments and contingencies, they showed like a few trends. Accrued liabilities from legal matters have decreased. There's a substantial rise in litigation charges, specifically due to the $106 million Colibri patent lawsuit that is currently under appeal. Also, the company faces high volume of product liability cases. You have the roughly 8,000 plaintiffs related to hernia mesh and 107 related to diabetes pumps, and this indicates considerable product-related risks. On the environmental front, Medtronic has made progress, such as the Penobscot, I don't know how to pronounce that, river cleanup, but it still faces ongoing site cleanups. Potential anti-corruption fines remain a concern, though no charges have been recorded yet. And unresolved income tax disputes could impact future cash flows. So while they're handling their environmental issues and accrued liabilities, sharp increase in litigation charges and ongoing product liability cases, they do present risks moving forward. For Abbott, their commitments and contingencies, they also showcase some trends. As Tice mentioned, they recently acquired Bigfoot and CSI in the past year, which just shows and supports strategic growth, though they're not expected to significantly impact the company's financials. However, Abbott's debt obligations are more pressing concern. specifically the $1.1 billion due this year, which are due to increase by about $7 billion to 2029, along with substantial interest payments. In terms of legal proceedings, the most notable issue is a $495 million jury award related to a preterm infant formula case, which Abbott is also appealing. While the legal matters seem less concerning, this award could have major financial impact depending on the appeal's outcome. It is $500 million. And overall, the rising debt and interest obligations, along with the potential implications of legal claims, are the most significant factors to monitor moving forward. So equity accounts. First up, Medtronic. The most recent equity account changes revealed a strong focus on returning capital to shareholders. Additional paid-in capital dropped by about $2.3 billion due to significant share repurchases, and this just signals shareholder returns, but also limits the company's ability to reinvest in growth in the near term. Retained earnings saw a slight increase. You see $144 million. Though high dividend payouts continue to constrain further growth in this area. Accumulated other comprehensive loss rose by about $92 million, reflecting external risks like currency fluctuations that could further impact the balance sheet in the future in a negative manner. They also saw a slight uptick in non-controlling interests, and total shareholders' equity decreased by about a little over $2 billion. Mainly due to capital returns. So yeah, Medtronic's emphasis on returning capital to shareholders may restrict its capacity for future growth and reinvestment in the immediate future. Abbott's equity accounts. Common shares increased by about $149 million. Driven by stock issuances and employee compensation. At the same time, common shares held in Treasury dropped over 200 million due to share repurchases, which showcases their focus on returning capital to shareholders. The company's earnings employed in business rose 800 million. Accumulated other comprehensive income loss increased by 296 million. Bringing the total to 8.14 billion. And these losses were largely influenced by currency fluctuations as well. So when comparing the two, there are some differences. Abbott's higher retained earnings show a stronger focus on investing in the business, while Medtronic's has been more focused on returning capital to shareholders. Abbott also faces larger comprehensive losses from external risks, while Medtronic, their losses aren't really comparable. They're smaller. Abbott also has seen more growth in non-controlling interests, indicating stronger or expanding partnerships, whereas Medtronic's minority stakes have remained stable. And then lastly was Medtronic's tax deferrables. Let's see. For both, they were listed under deferred tax assets and deferred tax liabilities, respectively. For Medtronic, they dove into net operating loss, capital loss, and credit carry forwards, totaling to about almost 12 billion in April of this year. For Abbott, it was net operating loss, reserves, credit carry forwards as well, which is about 9.9 billion before valuation allowance, then reduced to 2.863 billion after. Both companies, they do have large deferred tax assets and liabilities. Medtronic's net deferred tax assets are significantly higher, mainly due to a lower valuation allowance and different composition of deferred tax components compared to Abbott.